Hi everyone, and welcome back to Stefan Livera Podcast, brought to you by Bold. For American listeners, you can buy Bitcoin over at getbold.io. Now, joining me today is Andrew Hohns. He is founder and CEO of Newmarket Capital, also a founder of Battery Finance. I had the pleasure of meeting Andrew just at some, Bitcoin conferences and events, and always enjoyed my chats with Andrew, and excited to chat with you. So welcome to the show, Andrew.
Thank you, Stefan. Happy New Year. It's great to be here.
Thank you. Yeah. So, look, I know you're doing a lot of interesting stuff, and you've been talking about and building this concept of battery finance. And so we're going to get into all that, but maybe if we could just start at a more high level. We're talking about this market for Bitcoin. Many of us are long-term believers in Bitcoin, but the market for Bitcoin collateralized finance, I'm curious where you think that is. Is that on the relatively immature end? Is it becoming more mature? Where would you place it today?
Well, it's definitely becoming more mature. You have more and more participants that have entered the market, and there's greater liquidity, but it remains very focused around short-term borrowing facilities. People that collateralize the dollars that they need, and often only available in the form of stable coins, which are different from dollars that go right into a bank account, right? That you could use to buy goods and services from people that aren't set up to accept stable coins. So you have short-term facilities, typically pretty high interest rates, and usually the liquidity that you can obtain is USDC or USDT. And I think that as useful as some of those products are, they're extremely difficult to use to finance long-term plans, and they're also difficult to use to finance things and generate a positive spread on your activities. It's hard to earn enough on a commercial real estate project or a development project to pay a high teens interest rate. And so you have mark-to-market risk, you have liquidity risk, you have stablecoin funding, and you have high interest rates. And that's introduced some considerable constraints, let's say, in what kinds of projects Bitcoiners so far have been able to execute, even with an asset that has appreciated incredibly in value.
Yeah, I think it's a great summary there, because I don't have hard stats on this, but kind of just from colloquially talking to people and kind of seeing how things have gone, it seems to me that a lot of the Bitcoin borrowing has been to kind of go lever long Bitcoin. Right? Like, it's because people want to borrow and they want to lever up on Bitcoin, not because they want to deploy it into real, quote unquote, real world assets, businesses, this kind of thing. I'm curious, what's your view there? Do you agree, disagree, or how would you categorize?
I agree. Bitcoin's returns on their own are pretty much the only thing that have dependably outpaced high teens interest rates. And so if you borrow with a conservative leverage ratio, then you can make it across cycles, and you can use the financing facilities. Of course, a lot of people have not borrowed with conservative financing ratios, or they are taking extremely leveraged positions in Bitcoin's price direction, and the chips get swept off the table. That's not at all what we're talking about. But I think that people that are using these short-term facilities to acquire more Bitcoin, it makes sense because the Bitcoin is liquid, but to use a short-term facility to acquire something that's illiquid, like, for example, whether it be a home or a development project in your city or in your hometown, or to invest in some equipment for your business. I mean, once you buy some equipment for your business, it's not easy to liquidate that. And so you have a mismatch between the horizon that you're using the capital good for and the financing that you've used to obtain it. And I think that has led people to really be cautious so far in tapping into what is otherwise the exceptionally strong financing potential of Bitcoin to power their real world dreams and objectives.
Yeah, and I'd love for you to explain in your own words, why is Bitcoin exceptional from a collateral perspective?
Well, I think that for people that have tuned in and crossed the thread, Bitcoin is interesting. I was in a meeting yesterday, and somebody said, once you go down the rabbit hole, it's a one-way It's a one-way door. And that's my experience. Once people open up their minds and they really start digging into Bitcoin, the deeper you look, the more interesting it becomes. Michael Saylor has that expression, which I think is very true. He doesn't know anyone that has spent, I think he says 100 hours looking at Bitcoin and hasn't walked away with extraordinary conviction. I don't know anyone who's spent 10 hours, like actually spent the time and hasn't walked away with extraordinary conviction and really fascination about Bitcoin. And it's fascinating from many facets, whatever your interests are. It could be your interests are monetary policy or financial history or the structure of government, or even, of course, software, hardware, integration with energy, Bitcoin culture. All these different facets are fascinating, and whatever someone's particular personal interests are, they can usually find a deep outlet for that within Bitcoin and think about their interests in a new way. So once you cross that threshold, it is a one-way door. But what we were saying in the meeting is that it's a fascinating one-way door because it's a one-way door, but it's surrounded by a force field, which prevents people somehow from even stepping across that threshold, because there are so many people that won't even start the journey, and they are, they're erecting obstacles for themselves that are preventing them from beginning that process. And I think it's fascinating in that regard. I've never seen something where the ratio of how interesting and compelling it is to the strong feelings about not wanting to look into it, but not really doing the work about it, is so high. So, that's a little bit of the tension. In terms of what are the characteristics that make Bitcoin excellent collateral, I mean, starting with probably, at the top of the list, I have three different legs of my stool when I think about Bitcoin's valuation. The first are its characteristics as money, as digital capital. And there, it's finite. That's extremely powerful. Gold is not finite. It's growing by 2% per year, roughly, in terms of industrial production. And so that means the half-life of gold is 35 years. If I gave you an ounce of gold today and you held it for 105 years and gold continues to grow at the same rate, your share of gold network has diminished by 87.5%. I mean, that's an enormous reduction, and that has a 35-year half-life. Silver's half-life is much less. Cash's half-life is, extremely short because cash is growing so rapidly. Bitcoin's half-life is infinity. It's not growing once we get to that 21 million cap. And the difference between an infinite half-life and a 35-year half-life is enormous in mathematical terms. So the first thing is it's finite, and that's meaningful, but it's not just finite, it is fungible and divisible. Honus Wagner baseball cards are finite. There's only around 12 of them, but they're not fungible. Each one has a little bit of a different grade. They're not divisible. You can't cut the corner off of one of the cards and retain the remaining fraction of value within the other card. And the same goes for art. The same goes for wine. The same goes for a classic car. For real estate, it's hard to subdivide and sell just a fraction of a share of a well-located piece of real estate, not to mention it's not liquid. Bitcoin is also weightless. It's portable. It's programmable. It has so many different characteristics that make it excellent as a store of value and as a means of digital capital. And then the second leg of the stool that we think about is Bitcoin's versatility. And there, I'm referring, Stefan, to applications that employ Bitcoin. They support it as a store of value, but they're not actually using the Bitcoin as a store of value per se. And there like you have
time-stamping kind of things.
What's that?
Time-stamping as an example.
Time-stamping or energy management, like what's happening in ERCOT with the Large Flexible Load Program, and similar things are happening in Tennessee and Tokyo and the United Arab Emirates with 02 and Marathon and the partnership that they have, or orphan oil well and natural gas well emissions recapture, or landfill emissions recapture, what Gridless is doing in Africa with run-of-river hydro. And beyond energy applications, there are many, many applications for Bitcoin, like SAT streaming or cyber walls, in terms of cybersecurity and creating impenetrable servers to address spam and the challenges of phishing. And when you start to think about Bitcoin's ability to power digital gates or to support e-gaming or to support new financial applications through value streaming and value for value, not to mention payments and remittances, not to mention timestamping, which plays a very interesting role for current events and for cataloging history and for news, not to mention all of the energy. The versatility of use cases for Bitcoin is off the chart. Everyone is using it for these useful reasons, and that is introducing demand for the asset that underpins its proposition as a store of value, but it's not directly related to it being a store of value per se. So it's excellent savings technology on the first leg of the stool. It has all of these other applications on the second leg of the stool. No one's using gold to balance the grid. No one's using gold to create cyber domes for anti-phishing and spam protection from a cybersecurity point of view. And then the third factor, which is not intrinsic to Bitcoin, it's extrinsic. But the third factor is the fact that we're typically measuring Bitcoin's performance in something that has no cap, which is dollars, euros, yen, sterling, yuan, Canadian dollars, and so on. And because we're expressing Bitcoin's returns in a unit where there's no ceiling to the quantity of money, it will produce very, very significant fiat-denominated returns in Bitcoin for the foreseeable future. Because there is, as Lynn Alden brilliantly put it, nothing stops this train, at least not for the very foreseeable future. You have Social Security, looming crisis 2034, many entitlements, demographic challenges coming into focus, and we're going to see a lot more quantity of fiat money. And it's every crisis. It's not even just the big ones. I was doing a review the other day for a presentation, and you think of like the global financial crisis, you think of the European sovereign debt crisis, you think about COVID, the big ones. But then if you go back and you look, the 2015 Chinese stock market crash, 2016 Brexit, 2018 Turkey, lira, and the Italian bond market sell-off, 2019 hyperinflation in Argentina, 2020, yes, COVID, but also Russia-Saudi oil price war, 2021 Evergrande, 2023 Silicon Valley Bank. Every single one of those, we saw significant introduction of lower cost liquidity, significant increase in the quantity of money, and very, very accommodative monetary policy. So it's the go-to strategy book for whatever the crisis is. And when you're measuring a finite asset that is not just finite, but it's also versatile, and it's weightless, and it's divisible, and it's fungible, and it's all of those transparent, auditable, decentralized. It's all of those things. It makes for a very, very interesting value proposition. And then just to mention one other, to bring it back to your original question, why collateral? All of that's a good reason to have a long position in Bitcoin. But why collateral? If you're a lender and you look at the kinds of collateral that are available today, like real estate. Real estate's, many people I think would say top of the heap when it comes to collateral. But if something goes wrong with a loan that you've made and it's supported by real estate, it's not like that you can recover against the real estate. That's why banks have entire workout departments that spend 12 to 18 months repositioning the asset. They have to manage it. Something might go wrong. The roof might leak. They have to deal with tenant issues. They have to find a buyer who wants that particular asset in that market. It's not divisible. It's not liquid. And that's why you have these big over-collateralization ratios. But Bitcoin, if you add it as a form of collateral to a traditional financing package, it really, in our opinion, depressurizes the recovery, because it means as a lender that you still have collateral in the traditional loan. That's no different in the traditional asset. But you also have collateral in this other asset that is trading 24/7, universal, fungible, transparent, divisible, liquid, all of these other factors. And it gives you options as a lender that I think are very worthwhile for their attributes as collateral, in addition to the fact that it's trended to appreciate over time.
Back to the show in a moment. This show brought to you by CoinKite.com, the creators of the best Bitcoin hardware security devices such as the Cold Card Mark IV and the new Cold Card Q. Now, we use Bitcoin hardware security devices to keep our keys offline, our private keys offline. Now, the way these work is you can do that setup, write down your 12 or 24 words on the seed word cards, and keep that secure. Now, you can use this device to interact with the Bitcoin network using software such as Sparrow Wallet, Electrum, or Vector Desktop, or Nunchuck as a few examples. Now, you have a range of security features that you can use with these devices, such as passphrases, you can use seed XOR, or my favorite is multi-signature. Now, if you're starting in a basic way, just start with the device and the USB-C cable, plug it directly to the computer and use it that way, and then later improve your setup. But I believe these devices are great at helping secure your coins, especially as you start to migrate up into multi-signature security. But don't be disheartened or don't be scared away. They are accessible, and I think you actually do learn about Bitcoin in the process. So to get yours, go to coinkite.com, use code Livera to get a discount on your cold card. And now, back to the show. Fantastic. And so, yeah, as you were saying, it's these different qualities of Bitcoin that make it a special thing from a collateral perspective. And I know, at least some of the lenders that have, been around, it's been an interesting, I guess they've mentioned this idea that, look, it's a 24/7 market. You can instantly sell, this kind of idea using like an over-collateralized model, like an Unchained or a Ledin or others out there. And I guess one other question I think a lot of people might have, and I'm curious to hear what your answer on this is, why have Bitcoin borrowing interest rates been so high compared to other things? Is it just that those other things are central bank government subsidized? Is that why mortgage rates are so much lower than Bitcoin borrowing rates? Or is there something else to this picture that is also in the picture?
Well, I mean, the Bitcoin market has been growing in terms of capital availability, but it's still very small. If you compare it to other even short-term credit markets, corporate commercial paper, or money markets, or something like that, Bitcoin is a tiny, tiny fraction of those. So, in order to attract liquidity, you have to produce returns that are so strong that you can attract that liquidity. And many of the, and the kind of liquidity that's been available so far is really just short-dated capital. Whether that's 1-year facilities or 6-month facilities or what have you, but they all have the kind of mark-to-market risk associated with them. So the key unlock for the market over the course of the coming years, and this is going to come, I think, in working with institutional investors like insurance companies that have asset liability matching mindsets, and also pensions that have asset liability matching mindsets, and other investors that can benefit from more efficient capital structures that are driven by things like credit ratings and tranching. I think the real unlock is going to come over the coming years when we can begin to build that ladder of maturity in funding that enables us as a community of Bitcoiners to develop products that are aimed at a medium to longer term horizon. To me, that's the most exciting thing that I personally can be working on, because I'm not going to be a great programmer. That's not my forte. But where I can contribute, I think, is really creating interesting new paths of capital markets availability to fund up what I consider to be an extraordinary amount of pent-up ambition from people that have built significant asset base within Bitcoin and have dreams and objectives and business plans, but don't have the financing tools yet to realize them.
Excellent. Okay, so let's talk a little bit about this model. You told me a little bit about it, I guess, offline in terms of battery finance and the idea here. So could you just explain a bit, maybe if you can walk through an example, maybe that would be useful as well.
Absolutely. We just announced at the end of last year the completion of our launch of financing for the platform, which is just the beginning. We have a pipeline now, several billion, in terms of borrower demand. A lot of people have been reaching out, seeking to integrate Bitcoin into either their existing traditional assets or seeking to utilize their Bitcoin to acquire traditional assets, but with stable financing structures. The first loan that we did is kind of symbolic. It's a multifamily apartment building in Center City, Philadelphia, on Bank Street, which I thought is nice. It's about a half a block away from the First Bank of the United States, which is really cool. But it's, loft-style apartment building. It's got arched architectural windows and exposed brick walls, and kind of looks like, cast iron facade, like that kind of thing. And about 65 apartments, 3 commercial units on the ground floor. There's a veterinary hospital in the building, a bridal dress store. And the owner of the property has owned it for almost 30 years. And the building had an appraised value of about $16.5 million, and it had a $9 million loan existing, a traditional loan without any Bitcoin. We made a $12.5 million loan, and the use of proceeds was to pay off the existing $9 million. So we're now the first mortgage position on the property, to provide a value-added financing for the sponsor, in the sense that we have provided $2 million for capital improvements to the property so that they can renovate some of the units as they turn over and make some cosmetic improvements in the common area and things of that nature, which will add value to the property and improve its position. And then with the remainder, which was $1.5 million, purchase Bitcoin. And at the time we purchased about 20 Bitcoin. Bitcoin was lower priced than it is right now. And that forms the collateral package for the loan, the building and its capitalized improvements plus the Bitcoin. So it's a unified collateral package in support of the loan. The loan has an interest rate which is designed to be rational and is designed to not overstress the property, a mid-single digits interest rate. And the borrower, they can repay the financing at any time with no penalty, no make whole, no yield maintenance or lockout. A lot of the obstacles that borrowers often face when they enter into a financing is that they're stuck in the finance. And we say, no, you're not stuck. You can repay it at any time. We'll release the real estate from any security. You can reposition the property, refinance it, sell it, anything. But we encourage borrowers to stay in the loan, because what we do, Stefan, is we say, if the loan is repaid at year 4 or earlier, the minimum length of time that we want to have the Bitcoin exposure is 4 years, obviously 4-year cycle. If the loan is repaid before 4 years, we release the real estate, but the Bitcoin stays in place. And then at year 4, we share in the upside. We get a majority of the upside of the Bitcoin. The borrower gets a minority. And then every year that goes by, we gradually reduce our share of the Bitcoin upside, and the borrower gradually increases their share of the Bitcoin upside. And so if they stay in the loan for the long run, they're vesting into more and more Bitcoin upside. The longer it goes, our opinion, our loan to value is going down, down, down. So we're getting into a better position in terms of the collateral security that's supporting the loan. We're still getting interest on that. So we're getting, paid to wait in terms of the liquidity that we've provided. And we're also giving the borrower a really valuable tool to redenominate some of the equity that they hold in this asset that they know and like, that they've held for 30 years, but redenominate that equity out of fiat and into Bitcoin, and integrate the dynamism of Bitcoin into their investment strategy without having to sell, some other asset in order to buy the Bitcoin. They're just thinking of it as Bitcoin equity. With this general construct, let me say like this. Usually a lender has only interest that they have to squeeze as hard as they can to get their return. That means that it's a adversarial relationship between the borrower and the lender, or if not adversarial, extractive, or if not extractive, zero-sum game. It's not, for the lender to get more interest, that means the borrower has less cash flow. And the more the interest that it becomes, the more stress that it puts on any project because of debt service coverage and That's why borrowers are always thinking, how can I lower the interest rate and how can I optimize this? And so they're spending all of this time and mental energy trying to optimize the financing when they could be using that time for other things that could be more value added for that project or more value added for their lives. And so what we're saying because we've added a new element, a third side of the paper, as Ross Stevens recently wrote in his annual letter, which is formulas that share in the upside of Bitcoin in a collaborative way between borrower and lender, a collaborative financing structure. We think we can deliver a level of interest that will incentivize the borrower to not be, always focused on how do I optimize it, how do I lower it, how can I refinance it. We liberate that whole entire work stream, and we say just be cool. Stay in this loan. You'll vest into more and more of the Bitcoin upside as time goes on. It's a very efficient structure for the financing, and it introduces Bitcoin economics into all of these assets that you know and like. So that's the essence of the proposition.
Gotcha.
Of course, depending on the over-collateralization rate and the cash flow of the business and the tenor of the financing and the amount of Bitcoin, the interest rate might be a little different. The amortization terms might be different. The appreciation sharing might be different. Those are all kind of commercial terms that we work with the borrowers to develop in a private credit way. But those are the tools that we have in the toolkit.
Yeah, I think it's really interesting because it can, let's say, open things up for more people who don't currently hold Bitcoin and want to, or on the other hand, the typical case of like a Bitcoin hodler who has a stack but doesn't want to sell his Bitcoin to whatever, to do some project. So I guess am I right then that those are kind of the two, let's say, target customers or target borrowers in this model?
Yep, exactly right. You have asset owners that have assets that they know and like, and they don't want to sell them necessarily. Maybe they're strategic for their business or strategic for their lives or important for their portfolio, or they're emotionally attached, or whatever the reason. They're all valid. And they maybe have existing financing on those assets. This is a tool for them to refinance and to redenominate some of the equity into Bitcoin. And we think that it's a much better proposition for them. And then on the other side, to your point, you have the hodler community, which I love working in Bitcoin for many reasons, but probably the top reason is the people. And when you go to meetups, and I know you know this because you have one of the top podcasts in the space, and you've been at all of the conferences for so many years, and you've met everybody. It's a fascinating group of individuals, and they're very entrepreneurial. They're very principled. As Bitcoin has grown, they've become quite asset rich. They have big ambitions, big plans, a big desire to see those through. And the idea that these kinds of tools that we're developing could be a mechanism to enable Bitcoiners to actuate the objectives that they have in terms of a tangible world investing, let's say, that's like very exciting. That's a very exciting possibility. And I think it crosses a lot of different areas. I mean, a lot of people are talking about impact investment. That's a major thing for many, many years, impact. A lot of times when you have an impact investment, and this is conceptual, but you have what they call concessionary capital that comes in and it accepts a lower return in order to make the economics of an investment possible.
Right. If you ideologically want this thing to exist, you might be more inclined to invest in it, even if you could actually earn more elsewhere.
Right. And if you actually introduce Bitcoin into some of those impact propositions, it turns that on its head, because now it's strengthening the impact projects with the dynamism of Bitcoin over time. And if you can set the financing not at an extractive level, where in order to attract some private sector investors, you pay a higher rate of return by also attracting public sector concessional capital or foundation capital that effectively subsidizes a distribution of cash flows that makes everybody happy, because you got these ideologically motivated and these economically motivated. You can flip that on its head. You can say, oh, timeout. We can finance all of this with much more liquidity by delivering actually a much higher return, sharing some of the Bitcoin upside and giving the projects a much more sustainable cost of capital and giving the sponsors of those projects an asset that magnetizes all of the monetary energy of Bitcoin, right? It's, over time. And then, imagine, you have small businesses that add Bitcoin to their balance sheet. They already are. You look at the River Report. A lot of small businesses are doing that. But, you extend that, you broaden that, and you broaden that to cities and, people that are looking, rural projects. Imagine, I was talking to an individual in Canada who was telling me about the Crown Corporation that's focused on providing financing for farmers. And there's a big, there's a big intersection, let's say, between agriculture and Bitcoin. There's an intersection having to do with sustainable farming techniques, back to land movements, different kinds of dietary and nutrition. But there's also just kind of the operational integrity of adding Bitcoin as a component to farming, because farming needs heat. Farming, it has different kinds of localized power plants like biogas facilities or solar facilities, and they produce intermittent power, and the Bitcoin could be the purchaser of that when it's not being used for other agricultural purposes. There are all different kinds of ways to think about that. And I was saying to him, imagine if something like the Crown Corporation for the Farming Finance provided financing facilities for Canada's small and medium-sized farmers, even large farmers, to integrate Bitcoin as a component of the collateral for their family farms. Because family farms are longer-term investments, they're 10-year investments, 20-year investments, sometimes multi-generational investments. And so they have the ability to withstand the daily volatility if the Bitcoin is sized properly, and especially if it means that you could deliver them a lower cost of capital for them to grow their fundamental business, which is, in this case, the agriculture. And you can imagine that being applicable to not just Canada and farming, but many different geographies, many business types. It's a flexible model for impact investing that can really, I think, flip the script. And that's what Bitcoin specializes in, right? Flipping the script.
The lead sponsor of this show is Bold, the best place to buy, sell, and save Bitcoin. For listeners in the US, Bold lets you secure your financial future with complete peace of mind by integrating a low-fee, Bitcoin-only brokerage with next-gen multi-sig vaults. With Bold, you can smash buy Bitcoin or set a DCA plan for only 0.99% fees and seamlessly deposit the Bitcoin direct to your Bold vault. The Bold vault is a 2 or 3 collaborative multi-sig where you hold 2 keys and Bold holds 1 as a redundant backup, protecting against loss or theft. You can use Trezor, Ledger, or Cold Card hardware wallets to spin up a Bold vault in just a few minutes, and the Bold vault is the only collaborative custody vault available with 0 monthly fees. They're also offering 0 fees on your first $10,000 of Bitcoin buys and $25 of free Bitcoin when you buy $100 of Bitcoin or more. Try Bold today and upgrade your stacking experience over at getbold.io. And now, back to the show. Yeah, it's really fascinating to kind of think through what this means for people. I am curious now we've been talking a bit on the borrower's perspective. Now, if we talk about from the lender's perspective, what does it look like for them? Because I guess historically, the thing you might have heard them say is, why would I, lend you fiat when I can just turn around and use that fiat to buy Bitcoin for myself, or, this kind of thing. Does it make sense for some other reason, or is it maybe, there's just, such a large market for it in the same way that there's all these people dying to, falling over themselves to lend money to MicroStrategy for very cheap, this kind of thing. So I'm curious if you have any comment on the lender side of it and what's in it for them.
Well, capital markets are a continuum of different needs, and those different needs are expressed in time horizon, demand for liquidity, tolerance for volatility, overall return objective, ability to produce income. There are many different factors, right, that an investor could have. And some investors need income. Many investors do. Who do those investors include? They include people like pensions who have beneficiaries that they have to meet the payout schedule. They include insurance companies that have to fund the cost of current claims and losses and also produce dividends in order to make their shareholders happy, or retained earnings, as the case may be. They include endowments and foundations that are designed to generate income in order to fund scholarships and other charitable activities. and university research. So there are many different valid uses of income from the institutional investment world. And as a result of that, there is a strong demand for credit investments. And what are credit investments? Credit investments are investments that have a senior claim in the event of liquidation, so they're safer, and they produce a yield, but the yield is lower than what you would get if you were an equity investor, where you have a junior claim and you get the residual. You get whatever is left over, and you're happy because that's what your objectives are. And so we're not really focusing on people that would otherwise just want to buy Bitcoin and absorb 100% of the volatility. We're not saying to them, we have a better mousetrap, or, we've got something that you should consider instead. What we're saying is, for people that have in mind the desire to generate income from credit, this is a much, this is a modern approach. This is a much more sensible approach. Now, the main factor that we're solving for on the side of the lender or the credit investor is the challenge of inflation. And I'm going to say real returns are the right benchmark. Inflation-adjusted returns are the right benchmark. And because there's been so much quantity of money and so many, tricks and strategies with the interest rates and the QE infinity and the Operation Twist and the BTFP and the RQF and the ZFY and all of these other kinds of things that are coming down the pike that don't even quite yet exist, it is easy to lose sight of the fact that if you get your money back, quote unquote, you get your money back, you make a $100,000 credit investment, you get 5 or 10% interest rate for 5 years. And then 5 years from now, you get $100,000. You say, oh, I got my money back and I got a return. But unless you look at it on a real basis, you're not understanding the returns. And, the returns, I was in a meeting the other day and it just came out like some things do, phenomenal, as in nominal returns, right? So the returns are, maybe apparently phenomenal, but on a real basis, they're horrible returns because since just 2020, even using government statistics, the U.S. dollar has suffered about 20% cumulative depreciation. And so if you invested $100,000 and you got your interest and you get $100,000 back in 2025, that's like getting $80,000 back. So unless you have $20,000 of interest, you're in a negative position. If you only have, let's say, $25,000 of combined interest, 5% per year, you have a real return of 1% per year. You've absorbed all of this credit risk just to barely stand still. And you're not even rededicating all of that interest to principal because you're one of those investors that has legitimate needs for income, such as pension beneficiaries, endowments for research purposes, and the examples that we were given. So that's the situation that credit investors confront today. And not only that, but the landscape is about to worsen. Because if you're a student of financial history and monetary history, to me, it is overwhelmingly clear that the inflation in terms of monetization of prior debt is going to increase significantly over the course of the coming 5 to 10 years. We have looming benefits crises, Social Security, Medicare, pensions that are largely underfunded on an asset liability ratio. Illinois, the state of Illinois, 20% of their state budget last year was dedicated to pension support. I mean, that's a crazy factor. You have all of these sort of accumulated burdens that, and huge demography challenges, whether it be in Japan or for that matter, China, certainly United States, other places. And so I think it's clear that the way that these accumulated burdens are going to be sorted is that they will be satisfied on a nominal basis, but that the real value of that nominal satisfaction is going to be greatly lower because of inflation. So people, they might be expecting a monthly pension of whatever the amount is, $2,500, $3,000. They'll get it, but $3,000 10 years from now is going to be worth way less than $3,000 a month today. And that's going to be, but people will say, look, we delivered what we said we did. It was 3,000, here's 3,000. And that's very destructive, if you really play it out. So what we're saying is look, why not, why pivot later from a position of weakness when you can pivot now from a position of strength? And the question then becomes, if you're a credit investor, does it have to be a drain on real returns where you seek more and more risk in order to get higher and higher income to run faster than this never-ending wheel of inflation? Or can you instead reconceptualize it and say, time out, we can be more constructive on the rate of return current, we can focus on much more rational projects, deliver much more valuable financing structures, and at the same time, by introducing some Bitcoin into the structure and sharing in a collaborative way in the performance of that over the medium to long run, we can produce results as lenders where instead of just having a diminishing melting ice cube, like Michael says, but instead having a growing endowment and a source of strength for building out portfolios. That, to me, is really where it becomes a very interesting and compelling story. And institutions that adopt this earlier, and they are starting to. I mean, you saw news even just this week, Intesa San Paulo, Italy's largest bank, announced that they had bought some Bitcoin, and they've been studying it for some time. And, you're seeing some leading financial institutions beginning to engage in some of these activities in very interesting ways. But it's just starting. But it's going to take a few cycles for sure. And the ones that, because Bitcoin is finite, there's a really strong advantage to not delaying the decision to begin to build in Bitcoin.
Yeah, I think it's a really, as you've laid it out, really, inflation is coming. Most people are losing pace against the printer, and you need Bitcoin to basically beat the printer. That's that kind of, in very blunt, simple terms, that is the situation that a lot of people are in. As you mentioned, there should be appetite from some of these large insurers, pension funds, to come to the party here because they have obligations, and it would make sense for them to come to this party. So I guess I'm also curious in terms of, is this going to be, or at least from a battery finance perspective, is this a US only thing, or are you elsewhere around the world?
No, I mean, it's a flexible program. My background is credit investing globally for years. I've taken credit exposure in well over 50 countries around the world already. And a lot of emerging markets have done a lot of work over the years in many, many interesting places, and have had the privilege of meeting a lot of interesting people. And Bitcoin is global, and it cuts across all industries. When you start to go to Bitcoin meetups or conferences, you meet people that are dentists, lawyers, real estate professionals. Yes, of course, software engineers, hardware, but also people that have fashion companies, people that have hospitality companies, restaurant chains. They own hotels. They are real estate developers. People from all different kinds of industries have gravitated toward Bitcoin. And so you have, in my opinion, I think that the Bitcoin community is the single largest underserved cohort in the specialty finance world. And it's also full of people that are, like I said, exceptionally entrepreneurial. They have an asset whose long-term characteristics are phenomenal: trustless, verifiable, decentralized, auditable, transparent, weightless, all of the things that Bitcoin is, super well suited for financing, but they're just currently not being served. And so I really hope that we can form partnerships in many different geographies to attract sufficient funding because what's really needed to make all of these objectives in the tangible world happen for where we are in the evolution of Bitcoin these days is actually fiat. Right. Because otherwise, if you're buying the real estate with Bitcoin, well, you've sold your Bitcoin. You don't want to do that. Or if you're buying the equipment or the construction material, it's all the same. And so what you really need is people who are willing to provision fiat, which is a very short half-life, provision that fiat to exchange for things with longer half-lives, like durable goods, land, equipment, buildings, combine it with Bitcoin, and then share in the growth of those activities. We've been looking, I know that you're dialed in from Dubai. I think that the United Arab Emirates is just so incredibly fascinating, and I love traveling there. I've been there many, many times. But more generally, I would say principles of Islamic lending, which are also very similar, incidentally, to the principles that are articulated in the Torah, in Deuteronomy, and in Christian teachings as well, but which have evolved over the years. And nowadays, within the Islamic approach, I would say it's the most original in terms of being focused on these ideas of no interest and instead sharing in appreciation in credit arrangements. But because of fiat, virtually all of those kinds of structures are sort of like basic Western loans with the equivalent of interest masquerading in a structure that doesn't call it interest. And so you might buy an asset and sell it at a premium at the end of the life of the contract, or have some kind of, a discounted margin, or whatever the case may be. But that's because it's not because people want to get around the idea or sidestep the principle. It's because when you're building on fiat, it's quicksand. And if you can instead reconceptualize these concepts of appreciation sharing with digital capital that absorbs the monetary energy and absorbs all of the development that's happening in a world that's growing much, much, much more digital, which of course the world is in every different way, then you can actually develop structures where you're sharing in the risk on both the borrower and the lender side in a way that provides the community with a diversifying interest in Bitcoin, and it provides the lending pool also with a tool to diversify its interest away from the idiosyncratic business risks of those particular commercial operations. So I think, you asked, is this a global business? I think that for different markets in different places, there are ability to... Bitcoin is a new tool in the structured finance toolkit. And we have been building with it, and the results are incredible. It is a very powerful tool. And if you just open up your mind to what you can accomplish by engaging this seriously as a building block for structured finance and structured credit, you can accomplish really remarkable risk-return transformations and make not just possible, but make a probable and make, really advance the potential of many, many more projects in many different places.
I'm curious if you have any thoughts on what could go wrong. Is it just, as an example, could it be a person engages in this kind of endeavor, but actually their business fails? And, what kind of thing happens in that scenario? Is it just sort of, at that point, are you sort of hoping that you can wind down the business, or you're kind of hoping that Bitcoin goes up enough that you're still okay? Or how would that, if you could walk through, like, what might that look like?
I think that the thing that goes wrong is probably the number one thing is sorting through the time preference, and not just the time preference, but also the time horizon of the activity. And, if you add too much Bitcoin, because it is volatile, to a project, an initiative, a company that has the possibility that they're not going to be able to make a medium duration voyage with the Bitcoin, then that's where it becomes potentially very risky, because you'd be in a situation where you need the liquidity. And of course, Bitcoin is famous in the short run, famously volatile, and understandably volatile for many different factors. And so to me, a responsible approach to building with Bitcoin as a tool is to size the Bitcoin component of the collateral package and size it appropriately and pair it with projects that have a long enough and foreseeable enough ability to generate the carrying cost income that is necessary to carry the debt with a rational cushion, so that you don't have a situation where you have a liquidation toward the shorter horizon. If you can make it through 4 years, let alone 8 years, let alone 12 years, then that's where you begin to really benefit from the logarithmic expansion and the rate of adoption and all of the versatile use cases that are being built. And that's where you can, get above kind of the hysterical movements of the market and think about it more in a calm and purposeful way.
Right. And as I recall, I think from one of our offline conversations, you mentioned this is, in a sense, part of this is that's your business, right? You're assessing the credit worthiness of that business to say, okay, is this a viable business, or no, this is an unprofitable idea, therefore we wouldn't make this loan, that kind of thing.
Yeah, exactly.
So I guess that's probably so that's an element, that is an important element that can't be neglected, making sure it is a profitable, or at least very likely to be a profitable venture.
Yeah, having a professional approach to the underwriting that is risk informed. Because even as a lender, the last thing that we want to have happen is an asset that doesn't have sufficient capacity to carry the debt in the short run, because then also we are along the volatility of the Bitcoin too. We don't want to be in that situation. We also especially want to have a minimum 4 years of exposure to the Bitcoin, ideally longer. And so we need to, by fusing the Bitcoin with traditional assets, we believe that we've created a vessel that is poised to make that longer distance voyage, just like you wouldn't sail across the ocean, on a surfboard. You need a proper vessel. You wouldn't even sail across the ocean really on an opti, a small boat, right? You need a larger boat that has to be outfitted to make that journey. You have backup plans, you have contingencies, you have enough supplies, you have resources. And of course, even then, some of the largest, most well-outfitted ships didn't make the journey. There you have diversification. So you have to have a mindset, okay, how am I going to build this in a way to underwrite it, to use our best judgment and create a pool of thoughtfully underwritten risk that is overwhelmingly likely to be able to make that medium to long run journey, and let the Bitcoin have its time to benefit from those three legs of the stool, all of its characteristics and the adoption that generates, the versatile use cases and many, many more that are being built every day, and the increase in the quantity of the money that we're being used to measure the returns in.
Excellent. One other question, I'm curious on if you have any thoughts on SAB121, if, let's say, the Trump administration, if that is taken away, and let's say some of the banks can enter the custody game, and maybe in the future they could also enter into the Bitcoin lending game.
Yeah, I think there's going to be big transformations. It's not, I don't think it's just, one regulation. We should pin it all on that one thing. I mean, you look at the strategic Bitcoin reserve, that is potentially super powerful. But then you say, oh wait, hold on. Brazil has introduced legislation to do this to the tune of 18 billion. And Poland, the presidential candidate there, is talking about it. That lady, I think she was French, the French member of the European Parliament, says, look, we have to start thinking about this as well. Then you have, what's the number that it's up to, 10 or 11 or 13 United States that are saying, okay, we should have these, kinds of reserves. And then you start to think about, okay, well, hold on, SAB121, that's interesting, but how about the FASB rule change? And the flowing through into the earnings of publicly traded companies, the movement in the Bitcoin, and it's not just the price movement quarter after quarter, but with the path that is being carved out by not just MicroStrategy, but Marathon as well, thinking about inventive strategies for corporate treasury, people are looking, okay, what's the Bitcoin per share? And then you're layering on a Bitcoin per share. How is that KPI, Bitcoin yield, manifesting quarter after quarter? How does the Bitcoin price movement move? What does that do to EPS? How can we use our balance sheet to deliver more EPS? I was listening to a podcast, what was it? I think it was True North, the MicroStrategy True North guys, and they had one of them a very interesting observation, which is like earnings. A really interesting contrast to be able to generate earnings from a balance sheet without the same kinds of operational risks and netting costs as you have to if you have a built-out network of retail stores and you're looking at what are the same store sales growth or year on year, quarter on quarter, or you have a large team of sales and distribution personnel in order to go and promote the product in different places. Any kind of operating business that has this focus on net operating income and says, look, we have this initiative, we've launched this new product, we have this whole team, we have this whole strategy. Yes, we've had expenses in getting it off, but here's the margin that we've been able to generate. And people pay a lot of money for that growing margin. And then on the other hand, you have companies that are saying, well, hold on, we're actually utilizing treasury strategies to generate margin with much less operational risk and a totally different set of considerations. I think that's going to create really fascinating new valuation models in publicly traded markets over the course of the next, again, this is not all going to happen in 1, 2, 3, 5 months. Some of it will, but it's a story that's going to unfold over 5, 10, 15 years, and in certain instances, much longer. And these new models are all leading to Bitcoin adoption at different pace, but it's at least several cycles before we see broad Bitcoin adoption. So it's not just going to be one thing in one country, SAB, FASB, strategic reserve. It's, the Czech Republic saying that anyone who hodls for longer than 3 years doesn't have to pay capital gains tax. It's going to be the accumulation of all of these policies, and not only that, but the coming of age of younger people that are natively digital, and of course the way that human progress works, that's always happening. But we have so many. The progress that we should anticipate from here to 2045 is exponential, and we should anticipate very significant advances in healthcare, in communication, in travel, in robotics, in artificial intelligence, nanotechnology. And all of these factors are going to be more and more and more digital, more and more and more supported by the technological architecture. And so Bitcoin, which is effectively technological money, is extremely positioned to absorb the growth in those spaces, while at the same time, it also is positioned to absorb the accumulated burdens of yesterday's fiat structure. And so that's why it's so interesting. It's like, I'm glad we're having this conversation in January, because January, the Roman god, Janus, has the two faces, one facing toward the back and one facing toward the future, the god of passageways, looking forwards and backwards. And I think that it's a really, really nice context for where we sit right now and the transitions that are unfolding.
Yeah, I think you summed it up really well in terms of all the different things that are happening. And, of course, I think there'll be downturns to come in Bitcoin, right? People shouldn't expect, it's just up only. But at the same time, there's a lot of reasons to believe that, this is a network, and this network is rapidly growing over time. More and more people are joining the network, whether they're individuals, family offices, businesses, governments, insurance, pension funds, etc. You name it. There's all these people who are joining. So it's just really fascinating, and I'm just here for it. I think it's going to be really interesting to see what happens with it. Yeah, and I think what you're doing is quite interesting because it is a different structure to what we've historically seen with Bitcoin-backed loans, and now it's kind of this meshing of the worlds of other assets and Bitcoin. And I think it'll be interesting to see how the market reacts with this, and what kind of interest there will be both on the borrower side and the investor side in terms of not having to mark to market, right? Like, I think that was a big thing, because one of the big things I think many hodlers can relate to is this idea of, okay, if I'm going to engage in some kind of Bitcoin-backed loan, what if we have an 80% drawdown like we've had before multiple times in Bitcoin? Have I got enough collateral to survive and withstand that, or am I going to get wrecked, right? And that's kind of playing on many people's minds. And so if people have this concept of, oh, okay, I've got this loan for 4 years or 8 years, then it kind of makes them more comfortable with that risk, I suppose.
Yeah, I think that's the key factor, actually, is transforming time preferences. Bitcoin lives forever, humans don't. And the ability to exchange the medium to long run performance of Bitcoin with the resources that you need in the short or shorter run in order to build the life that you're looking for within that moment in time. When you're in your 20s, you have different needs than when in your 30s. You have different needs than when you're in your 70s and whatnot, and different phases in life, and professional objectives and family demands and ability to travel and physical fitness and all of these different factors. And if you begin to think about how can I use the Bitcoin within the time preference, of where I am, and you can transform that because a financial services company, effectively like a battery finance, is in a position to absorb those time preferences in a different way, because companies can live forever, right? Companies do not have a finite biological time frame. Of course, they can run into risk that challenges that. If properly set up, you can have a very long horizon, and that allows for the transformation of time preferences. I would just say that whole idea of time preference, I have to credit the team at 1031. They call their funds the low time preference funds, and they've been phenomenal partners for us in the growth of Battery, but beyond that, they just have such an interesting portfolio of builders in the Bitcoin space, and their attitude, which is lowering time preference and really thinking about how do you build durable structures that are meant to last, kind of have the Bitcoin ethos. You also hear about this with like Bitcoin urbanism, and some of the people that are talking about new Bitcoiner modes of approaching architecture, Bitcoiner modes of approaching agriculture. We were talking about that earlier. As you infuse this through different industries, it's an ethos and it's a mindset. And I think it's helpful to conceptualize time preferences, especially in financial activities and in life objectives. If you can sort through your time preferences and articulate your goals over the context of the short, medium, and long run, you can accomplish.
Yeah, I just think so much of this stuff is really fascinating, and I just think it's a really interesting approach. So, look, Andrew, thanks for joining, and I found a really fascinating conversation and really intelligent perspectives you've been sharing. Just before we let you go, where can people find you online?
Newmarketcapital.com is where you can find us on the web, and you can send an email to battery@newmarketcapital.com.
Fantastic. Well, Andrew, thank you for joining me.
Hey, thank you, Stefan. It's really great to catch up with you. I can't wait to see you in person somewhere on the Bitcoin World Tour.
That we will do.